Hi everyone, welcome to your Daily 5. This is Friday, August 18th. I am Mish Schneider, Chief Strategist of MarketGauge.com, coming to you on behalf of Stock Charts TV. So for today, I thought it would be interesting to cover something that seems so incredibly unpopular, but for us, we're seeing signs that some of the commodities may actually not be done rallying, and there's always going to be the debate about disinflation, deflation, inflation, hyperinflation, stagflation. And of course, what we really try to tell you all the time, and the whole message of stock charts, and if you go back and listen to the final bar I did with Dave Keller, certainly he's in this camp, is that the technicals and the charts really kind of tell you everything that you need to know. So it's with that in mind, of course, I like to add a little bit of commentary about the fact that things like the agricultural ETFs, particularly looking at DBA, are still over the 23-month. This correction in the indices, if IWM holds, could be a little bit more bullish in terms of giving the markets relief that demand isn't completely destroyed after the China news. There are certainly signs of wage inflation that could be meriting watching. Shelter dropping has not necessarily happened, et cetera, et cetera, et cetera. So there are pockets and then there are pockets. And of course, the real inflation that could happen from any kind of chaotic situation, and I did find it noteworthy that part of the big retail box chains' earnings had a segment dedicated to how much money they've lost in theft. This is sort of a quiet type of chaos, a quiet revolution. So you have the wage increases on one level, and then you have the people who have just completely given up, who go in and steal. And this is not necessarily sustainable. It could go nowhere. But nonetheless, let's look at a few charts and see how they look in terms of commodities. So you can't really talk about commodities unless you talk about the bonds. So we're going to take a look at the long bonds and the dollar, and we'll look at UUP through the stock charts platform. DXY, we'll talk about that as well. And then, of course, gold and silver. I wanted to add natural gas in there, the agriculturals, and steel through the U.S. steel. And I did not put USO in here, so I'll probably add USO at the end as well. So let's get started with the charts. So the first chart we're going to take a look at is the long bonds. And there's a couple of interesting things to discuss here. Number one is we've seen this type of reversal that we're seeing as I'm speaking to you today a few weeks ago when we made the new low and gapped up, but we were never able to clear after this gap down the resistance up at around 97.40, and since we've seen, of course, another several days of decline with now the potential for another reversal. But what's more important to me than what the bonds do from here, of course the question is, have yields gone up enough? And we have Jackson Hole, and then of course we'll have the September meeting, is really will it matter in terms of inflation? And what it might do for equities if indeed the yields soften, but it doesn't do much for equities, but instead more for commodities. And one of the best gauges to look at is in terms of its performance in the Leadership ACP plugin, how it's looking on its relative basis to the S&P 500. And you can see right now, it is totally on par. If it starts to outperform, and particularly starts to take out the Bollinger Band, then I would be more concerned about inflation picking up and the stagflation that we've been talking about for quite some time. The other interesting thing here is on the momentum, because at this point we did have that mean reversion. We had it though after this was starting to roll over and run out of steam. Here, if we have a mean reversion, we're much closer to the low that was put in yesterday or Thursday on the 17th. And it could mean that we get a much bigger rally, maybe back up to that 97.40. But that would be a pretty significant rally, considering right now it's trading at 94.14. So this would be good for commodities. Now, UUP is interesting. The dollar itself, as I'm speaking to you, is at 103.44. Now, people are talking about it as a flight to safety and impacting commodity prices. But I find that the fact that it's over 102.50 is interesting, but the fact that it hasn't really been able to get over 104 or 104.50 when we're speaking pure DXY is also interesting. All it's done is held. It's not really showing anything great in terms of bullish or bearish to me. Now this is UUP, so this is actually the ETF. And right now you can see that we did clear the last resistance here. And if we go back a little bit further, we could be basing out. So I'm not saying I'm bearish the dollar. What I am saying is that it has to prove a little bit more to me before I start saying, okay, this dollar is going to scream. And I would think at this point it really needs to take out 28.90. You have a Bollinger Band there. That would go all the way back to last November, December, which was its last highs before it broke. And it would tell me that over 28.90 in UUP, yeah, we're probably going to see another move up. Maybe that move would go up to 29.50, maybe even 30. On the flip side, it is outperforming the SPY, as we can see. And in real motion, it's above the Bollinger Band. So to me, the flip side would be it runs out of steam here. We have a mean reversion in our ACP plug-in real motion indicator, which means it breaks down under the Bollinger Band. And if UUP moves below 28.60, let's call it, then perhaps the dollar will go down. Another potential bullish sign for commodities. Now, that doesn't necessarily mean all commodities will go up, but it would certainly give incentive for certain commodities to go up, and probably also, as we're seeing with the IWM today, give a bit of a relief rally as well to the overall equities. How much of a rally, though, it would remain to be seen. So let's move on now to gold. Now, I like to look at gold really futures, and it broke down under 1900. It got down to about 1885, maybe a little teeny bit lower just in terms of future prices. But if we look at GLD, there are two areas of risk off I look at as our big view product. Number one, of course, is how the TLTs are performing to the SPY. Well, we can see right now that they may be on par, potentially catching up if we see a bigger rally in the TLTs. The second is how gold is doing relative to the SPY. And today, gold is starting to break out or outperforming the SPY. This is risk off for equities, not necessarily for gold. And if we take a look right down here at the momentum indicator, we're below the zero line, and we certainly have not seen anything in the way of a mean reversion. But we could so easily have it. So now let's see what happened here in gold. To me, the most interesting thing about gold right here is that this was a big gap when it had a high on this day of 173.88. It gapped up the next day, and the low of yesterday was 174.93. So we came about $1 to filling that gap, but we didn't. We don't want to fill that gap. So if I were going to get into a gold position, I would probably say I'd want to see 173.90, give it a couple of cents, hold, and my stop would be right under that, knowing, okay, fine, wrong. But where would I get in? So far, all we're having right now is an inside day. We are under the 200, which means if we just go classic charting, the high of yesterday was 176.56. If it doesn't happen today and it happens on Monday, that's fine. I would then say you would have, if you'd risk down to around 173.89 and you got in, let's say, at 176.89, just to be clear, that would be about a $3 risk on an instrument that's trading up at 176 or 175. That's a very decent and small risk. Now, what I like even more is silver. And I've talked about this. Of course, looking at the charts, you have to wonder, why would I like it? It's underneath everything. It's under the 50. It's under the 200. Well, the reason is, first of all, there's that same level of gap which means, again, that we have a pretty good point to be looking at. It's a little bit bigger risk than we saw in gold, but essentially we can say that 1950, 1960 really should hold, and if we wanted to bring it up even more, we could see the low from this day, which was 1968. So we're trading a buck or so higher, much bigger risk relative to the numbers of silver. So I'd probably play it a little bit tighter. With silver, I would probably say that I wouldn't even wait for the gap. In this case, I would probably just say that the last 3 days we had lows of 2052, 2052, 2055. So there you go. Under 2050, that would be a really good risk. But again, am I ready? Well, number one is we're not quite outperforming the SPY here like we just saw in gold. But we did have not the cleanest mean reversion because it broke down underneath the Bollinger Band, didn't go anywhere, followed the Bollinger Band down. I would say we'd need to see a little bit more evidence on the momentum, ideally maybe to get back over this zero line. And then I would also, again, same kind of thing, maybe look for this to trade over the high of this day, which is 2108, or maybe even clear the 200. Or you could look at futures, and the futures, I think silver futures, if it trades over 23.50 an ounce, that would also be another indication. Now I want to talk about natural gas, because natural gas has been under a lot of pressure, and we saw a couple of interesting divergences when we talked about the natural gas last time I've talked about it, or at least in other media where I talked about it. And one of the divergences, of course, is, and I'm trying to pull this up a little bit here, sorry about that, as I manipulate this. Okay, it doesn't want to be manipulated. So what we can see here is that the natural gas is basically on par performing with SPY, which is pretty amazing when you think about the fact that natural gas hasn't done anything, really. And it had a mean reversion on this spike up here. This was that great big rally that looked like it was just going to take off, and it fizzled out. You know, the Widowmaker has its apt name. But here's the biggest divergence. It's not necessarily where the dots are. It's the fact that the 50 is over the 200. So we have a bullish phase in momentum. We have an on-par situation with SPY, but we're in a bearish phase in price. So that makes the decision relatively easy. If we can get back over 2 days close, this 50-day moving average, and go back into a recuperation phase, then I would say this would be worthwhile. And your risk could be somewhere under 660, 650. Again, if we look at prices of the futures, I'd want to see 250 hold up. It's currently trading about 255. I'd like to see it get back through 280 and eventually 3. Seasonally, we're not quite there yet, but natural gas could be seasonally in the fall, something to keep an eye on. The next one is DBA. Now this is where wheat, corn, soybeans, live cattle, hogs, coffee, sugar, cocoa, OJ live. Now OJ has been screaming to the upside. Cotton, cocoa, and sugar have held up pretty well near their highs, even though they've come down from the highs. Wheat really collapsed, but it's up on the day today along with corn and soybeans, and I think there's a big USDA report coming out next week. Nonetheless, this broke down under the 50-day moving average, and we're starting to see some momentum up in price. We did held this gap low here at 2080. That was a good point that I was watching. And now, once again, we're in a caution phase, well outperforming the SPY. And we're in the same caution phase, by the way, in real motion, which means it's the 50's above the 200 and the dots are below the 50, so there's no divergence there. However, worth watching to see if this clears back over the 50, number one, or if this clears back over the 50, number two, in which case that would tell you that even the grains are going up. Next one is actually a company, not a commodity, but it's U.S. Steel. Now, with all the negative talk, and I know there was some news about with negotiations, et cetera, but nonetheless, this went from way down here to way up here. It was so typical of what commodity-type companies do. And it's a little bit skewed with this gap. But if we're looking at gap trading, we now have a great risk, right? 28.05 is the low. And even though we haven't gotten clearance of the 32.52, we're doing a lot of work between those two. We take out 32.52, you have about a $4 risk. I would certainly keep it as a small position, but now we have to go back and see where this was in April when we peaked in inflation in 2022, and it traded up to 39.25. Certainly worth keeping an eye on. And finally, let's just, since I said I was going to look at it, take a look at USO. We're holding $80 a barrel in terms of oil. I think that's an important level. It's a breakout level. We got up to 83, close to $84 a barrel. We've come off. This, of course, is the U.S. oil fund. And we are still in a bullish phase. We are still outperforming the SPY. We did have a mean reversion here in the momentum. And so, again, we need to see more. What I find interesting is we had an inside day on Thursday. We're having somewhat of a second inside day today, which tells me that we get back over 72.82, let's call it 73. It depends on how long you want to hold the trade. For us, we've been long from way back here when we talked about it, I think, on actually a former daily 5. So we're keeping our stop really under 69. That would probably be where I would be looking at. And let's see what can happen. If this thing can get through $84 a barrel, can we go to 90, 95, or even $100 a barrel? Of course, people are saying, no way, China means low demand, et cetera, but we know that's only one small way to look at the oil market. Okay, I hope this was helpful to you, give you some things to be keeping your mind on. You all have a really wonderful weekend. Thanks so much for watching, and bye for now.